Imagine you want to check on your personal finances. You might start by gathering all your financial documents. You'd probably look at your bank statements, credit card bills, and other monthly expenses. You might also review the value of your investments, such as stocks, bonds, or mutual funds. A balance sheet does the same thing for a business, but on a larger scale. It's a snapshot of a company's financial health at a specific point in time, providing a clear picture of its financial position. Think of it like a photograph taken on a particular day, capturing all the financial details. It shows what the company owns, assets, what it owes, liabilities, and other financial obligations. Additionally, it reveals the value of the owner's stake, equity, in the business. This information is crucial for making informed decisions, whether you're an investor, lender, or business owner. It helps in understanding the financial stability of the company. Understanding the balance sheet is essential for anyone involved in the business. It helps you assess risk, evaluate performance, and plan for the future. By analyzing the balance sheet, you can make strategic decisions. You don't need to be a financial expert to grasp the basics. Even beginners can understand it with some effort. With a little guidance, anyone can learn to read and interpret this fundamental financial statement. Let's dive in and explore the details together. Every balance sheet follows a simple equation. Assets equals liabilities plus equity. This formula is the bedrock of accounting. It shows that everything a company owns, assets, is either financed by borrowing money, liabilities, or by using the owner's investments, equity. Think of it like buying a house. The house is your asset. You might take out a mortgage, which is a liability. The down payment you make is your equity. Assets are listed on the left side of the balance sheet. Liabilities and equity are on the right side. This arrangement highlights the fundamental balance between what a company owns and what it owes. Mastering this basic equation is the first step towards understanding the language of balance sheets. Assets are what a company owns that has value. These are the economic resources that can be used to produce goods or services and ultimately generate income. Think of them as the tools and resources used to generate revenue. They are essential for the day-to-day operations and long-term growth of the business. Assets are divided into two categories, current and non-current. This classification helps in understanding the liquidity and financial stability of the company. Current assets are those expected to be converted into cash or used up within 1 year. They are crucial for managing short-term financial obligations and operational needs. Examples include cash, accounts receivable, money owed by customers, and inventory, goods for sale. These assets are vital for maintaining the cash flow necessary for daily operations. Non-current assets are long-term investments that provide value for more than a year. They are essential for the company's long-term strategic goals and growth. This category includes property, plant and equipment, PPE, long-term investments, and intangible assets like patents and trademarks. These assets often require significant investment but are crucial for sustained business success. Each type of asset tells a story about the company's operations. They reflect the company's strategy, efficiency, and potential for future growth. A large amount of cash might indicate strong financial health. It shows the company's ability to meet its obligations and invest in new opportunities. A significant amount of accounts receivable could suggest potential cash flow issues if customers don't pay on time. This can impact the company's ability to fund its operations. Understanding the composition of assets is crucial for assessing a company's liquidity and its ability to generate future revenue. It provides insights into the company's financial health and operational efficiency. Liabilities represent a company's obligations to others. They are debts that need to be repaid over time. Like assets, liabilities are also categorized as current or non-current. Current liabilities are due within 1 year. This category includes accounts payable, money owed to suppliers, short-term loans, and accrued expenses, expenses incurred but not yet paid. Non-current liabilities are long-term obligations that extend beyond 1 year. Examples include long-term loans, bonds, and deferred revenue, payments received for goods or services not yet delivered. Analyzing liabilities provides insights into a company's financial risk. A high level of debt might indicate potential difficulties in meeting financial obligations. On the other hand, borrowing can also be a strategic tool for growth if managed effectively. Section 5. Equity your company's worth. Equity represents the owner's stake in the company. It's the residual interest in the assets after deducting liabilities. In essence, it's the value left over for the owners. Equity has two main components: shareholders' equity and retained earnings. Shareholders' equity represents the initial investment made by the owners, while retained earnings are the accumulated profits reinvested back into the business. Common stock and preferred stock are types of shareholders' equity. Common stockholders have voting rights, while preferred stockholders typically receive dividends before common stockholders. Retained earnings are a crucial indicator of a company's profitability and its ability to generate internal financing for growth. A healthy level of retained earnings demonstrates financial strength and a commitment to long-term sustainability. Section 6. Financial ratios, unlocking the numbers. Financial ratios are powerful tools that help you analyze a balance sheet more effectively. They distill complex financial data into understandable metrics. They provide insights into a company's liquidity, leverage, and efficiency, offering a snapshot of financial health. Liquidity ratios measure a company's ability to meet short-term obligations, ensuring it can cover its immediate liabilities. The current ratio, which is current assets divided by current liabilities, indicates whether a company has enough resources to pay its debts over the next 12 months. The quick ratio, calculated as current assets minus inventory divided by current liabilities, provides a more stringent measure by excluding inventory from assets. Both the current and quick ratios are commonly used liquidity ratios, essential for assessing short-term financial stability. Leverage ratios assess a company's reliance on debt financing, indicating how much of the company is financed by debt versus equity. The debt-to-equity ratio, which is total debt divided by shareholder equity, shows the proportion of company financing that comes from creditors and investors. The debt ratio, which is total debt divided by total assets, measures the percentage of a company's assets that are financed by debt, highlighting financial risk. Efficiency ratios measure how effectively a company utilizes its assets to generate revenue, reflecting operational performance. The asset turnover ratio, which is net sales divided by average total assets, indicates how efficiently a company uses its assets to produce sales. This ratio is a common efficiency metric, providing insights into asset management. Understanding these ratios and their implications helps you make informed judgments about a company's financial health and performance, guiding investment and management decisions. Section 7. Spotting trends, the power of time. Analyzing a single balance sheet provides a snapshot in time, but it's essential to look at trends over multiple periods. Comparing balance sheets from different periods reveals how a company's financial position has changed over time. For example, a consistent increase in cash might indicate strong financial performance. A steady rise in inventory levels could suggest potential overstocking or slowing sales. Tracking trends helps you identify potential red flags or positive developments. It allows you to assess whether a company is moving in the right direction or if corrective actions are needed. By analyzing trends, you gain a deeper understanding of a company's financial trajectory and its potential for future success. Section 8. Industry Insights, benchmarking your business. Comparing a company's balance sheet to industry standards provides valuable context. Different industries have different norms and expectations. For example, a capital-intensive industry like manufacturing might have higher debt levels than a service-based industry. A retail company might have a higher inventory turnover ratio than a luxury goods company. Benchmarking against industry peers helps you identify whether a company's financial position is strong or weak relative to its competitors. It allows you to assess its competitive advantage and potential for growth within its specific industry. Understanding industry benchmarks is crucial for making informed investment decisions and assessing a company's overall financial health. Section 9. Beyond the numbers, the qualitative picture. While numbers tell a story, it's crucial to consider qualitative factors that might not be immediately apparent from the balance sheet. Management decisions, market conditions, and economic trends can all significantly influence a company's financial position. For example, a company with a strong balance sheet but poor management might face significant challenges in the future. A company operating in a rapidly changing market might need to adapt its business model to remain competitive. Evaluating qualitative factors requires thorough research and due diligence. Consider reading industry reports, analyst opinions, and news articles to get a comprehensive understanding of the company and its operating environment. Section 10, the final word, balance sheet mastery. Mastering the balance sheet is an essential skill for anyone involved in finance or business. It empowers you to make informed decisions, assess risks, and evaluate opportunities. Remember, a balance sheet is more than just a collection of numbers. It's a financial narrative that reveals a company's story, its challenges, and its potential. By understanding the language of balance sheets, you gain valuable insights into the financial health and prospects of any business. Continue to learn, explore, and ask questions. The more you delve into the world of balance sheets, the better equipped you'll be to navigate the complexities of the financial world.